All right. So we're going to start talking about Chapter 1, mutual funds, Chapter 2, and Chapter 1 of the ETF book. Did everyone, was everyone able to get the ETF book? No? Can I see a show of hands who got the ETF book? You guys have to raise your hands higher if you guys are like this, I don't know. All right, so we got about half the class. Other half you guys will have it by next week, right?
Yeah.
Okay, great. Yes, sir?
We need it next week.
Well, you needed it last week, but by next week would be great. All right, so Chapter 1, the mutual funds industry, okay? That's fine. You can block the camera. Okay, about me, we covered this last week. We don't need to see my mug in the camera again, right? Boom. Okay, about the class, again, we covered this last week. Mutual funds, right? Big business. There's over 8,000 different funds with over $7.4 trillion in assets. That's a lot of money, right? Does anyone know how mutual fund firms make money? Managing. But how do they make money?
Commissions of trades.
Fees,
Yeah.
commissions. What are they based on?
Based
On the money people to pay.
Percentage of assets, right? So there's going to be a management fee, right? The management fee is going to cover, the costs for, the professional investment managers. And we're going to have a discussion too about what's the difference between an ETF and a mutual fund too. Even though that compare and contrast isn't on the slides, we'll have a class discussion about it. Okay, 8,000 different funds. How are mutual funds managed generally?
How? By a portfolio manager?
Yeah, by a portfolio manager. Are they managed actively or passively?
Active?
Generally, they're managed actively. Do you guys know the difference between active and passive management?
No.
No. Okay? Active management is you have a stock picker, right? Somebody who has like some formula or some form of analysis, and this analysis might be like picking up the phone and talking to the managers. This analysis might be done by a computer. This analysis might be done by just like gut reaction. There's so many, there was always this like story about like some guy who, picked stocks based on like bird migration patterns. Don't ask me how, the complete story. But, did it work? Maybe, maybe not. Is it a correlation? Probably not, right? It was probably just by accident. Maybe he made money, maybe he didn't. So you have portfolio managers making decisions on what to buy and what to sell based on a number of different possible models, okay? 8,000 different funds, right? Who buys these funds?
Investors?
individuals.
Everybody, right?
investors.
Institutions, foundations, endowments,
Yep.
universities, people for their retirement funds, right? A number of people could be buying, these, these mutual funds. Anybody can pretty much buy a mutual fund, right? What are some reasons we use mutual funds? Why not just pick stocks? Why buy a mutual fund? Why don't I just buy the Facebook IPO and Google and Apple stock and BlackBerry stock because it's so cheap right now? Whoa. One more time. Diversification, right? But diversification I can achieve by myself, right?
It's convenient.
Diversification, you said it's convenient, what'd you say?
It lowers your risk.
Lowers your risk when you diversify, right? How much time do you guys have to spend on researching stocks? None, right? Not a lot, right? Do you guys know how many stocks are in a diversified portfolio? About 30. 30 is the number they say to achieve a diversified portfolio, as long as you're picking like a mix, you know what I mean? If you pick like a bunch of computer companies, right, you're not really diversified at all. You pick about 30 different stocks, you're going to be well diversified. Even if you pick 30 different computer stocks, what will happen is you will not be exposed to any particular company. You've now basically created an industry portfolio, right?
Sector.
Yeah, a sector, industry, whatever, right? So you've now created that portfolio. So if one company goes bankrupt, it wouldn't affect you because one company going bankrupt means there's more for everybody else. So it would kind of be a wash, right? Like, oh, there's one company, HP goes bankrupt, but Apple stock jumps up because why? There's one less competitor out of the market, right? And vice versa, okay? also accommodates investment strategies that would otherwise not be feasible. What do they mean by that? Well, anyone here have an E-Trade account where they can buy and sell stocks? Besides me? Okay. I haven't bought any stocks in a while. E-Trade is like a brokerage firm. Okay. Every time I buy a stock or sell a stock, it costs me about $10, right? So if I want to buy 30 different stocks, how much is that going to cost me? 30? 300, right? It's going to cost me $300 to buy 30 different stocks. How much is it really going to cost me to sell them? Another 300, right? So if you're going to buy a stock, you can't just spend $500. Because if you spend $500 buying a stock, it's going to cost you $20 to buy and sell it, right? And you know, $20 is like an automatic loss. So you've paid $500, right? But you're really already down to $480 because of the investment costs. Does that make sense? Okay. So and how much is that? How much money do you have to make? How much of a percentage do you have to make to recover your trading costs?
5%.
In that example, right? What is that? $20 on 500? Is that 5%? Anyone have a calculator? Don't make me do the math in my head. Okay?
1%, it should be 1%.
$20 on 500?
Yeah,
1%.
it's $25.
4%.
What?
4%.
4%, right?
Well, you want to gain, you don't want to.
No. He's right.
That's just for
Right? So you would need your stock to go up. If you only bought $500 worth of stock, you would need your stock to go up by 4%, right? Just to break even, right? So it doesn't make any sense to buy that little, right? Because of the trading costs involved, right? You wouldn't make any money. And how much in a normal year, if we average it out, does the stock market grow?
10%.
8, they say. I mean, but that's an average, you know? An average, you know, when we talk about averages in general, averages are always foolish, right? Because I could say, on average, in the last 2 years, we've only had about 40 inches of snow. But 1 year, we had 90 inches, and this year we've had nothing. What does that mean? It doesn't tell us anything about how much snow to expect, right? Does that make sense? Okay. So same thing there. So if on average, a stock could only go up 8%. I mean, you know, there's going to be years where it goes up 15%. The market itself will go up 15%, and there's going to be years where it goes down. You know, goes down 12%. So, you know, that's when we talk about investment strategies that would otherwise not be feasible, right? We're going to spend all this money on trading costs, right? It's going to cost us a ton of money. That's also what we're talking about with economies of scale. You know, the mutual fund is a big organization, and they're not just going to buy $500 worth of stock. They're going to spend $500,000 on one stock, right? It's going to be composed of many different stocks, right? And the thing is that whether you're buying 10 shares of a stock or 1,000 on E-Trade, right? I'm still going to pay $9.99 per trade, right? So isn't it better just to buy, buy in bulk, right? If you spent $10,000, right, on a stock, and it still costs me $20 to buy and sell, what's $20? What's $20 as a percentage of 1,000?
2.
Is it 2?
2.
Let's see. Yep, 2%. I don't know why I didn't do that in my head. Okay. Sorry, I thought I meant to say 10,000 where it would have been 0.2%, you know. But you guys get the idea. The bigger bulk you buy, you know, you're lowering your costs. Right? Reduction of risk by holding a diversified set of assets. We understand that already, right? I just explained that. This book and this course will focus primarily on open-ended mutual funds. Okay. We talk about ETFs. Right? ETFs are not open-ended mutual funds. That's a different topic. So, as I said, I'm shifting this class towards mutual funds and ETFs. Okay?
I kind of forget what open-ended is again.
Yeah, he had all
ETF.
times to sell.
What's that?
Okay. Yeah. All right.
Sorry, what was your question?
No, I just answered his, he said what was open end, and I said it's ready at all times to
Give me
sell.
some support.
Got it.
Because I was researching all
That's
this.
fine. Okay. Open-end shares are ones that will always sell or redeem to shares to investors. Okay. They are priced daily based on their NAV. So when we go to buy a mutual fund, when I buy it, I put in the order. I forget the cutoff time. That's really that's a minute topic. I would never quiz you on what's the cutoff time to buy a mutual fund. But let's say I put in a buy for a mutual fund. It's a close to the market, I believe. It's like 4:30. I put in a buy for a mutual fund at 2:30 in the afternoon. I don't know what that price of that mutual fund is going to be, right? When it actually executes. I know what the price was yesterday, right? There's no intraday pricing, right? It's priced daily, okay? So I see what the price was yesterday, and I'm like, all right, it was $20 a share for this mutual fund yesterday. I'm going to buy it, right? At the end of the day, when I put in my order's in, and when the market closes, the portfolio accountants who work at State Street or whatever start calculating the NAV. What's the NAV? The NAV is, I'm not going to draw it on the board, it doesn't make any sense to. It's the value of all the shares in the entire portfolio divided by the number of shares in the mutual fund. Does that make sense? And I'm going to ask this. I'm going to ask you guys a lot of times. Does that make sense? And if it doesn't make sense, I'll be happy to explain it again. Okay?
Securities minus liabilities divided by shares outstanding.
Yeah, because it could be liabilities and stuff too. When we talk about like loans, we get into funny stuff like leverage and stuff like that. But you know, as a basic concept, think of it as this. You know, if we hold, you know, 10 different shares of stock, right? We just look at the value of all those stocks combined, all that we hold, and then what do? Right? And then we divide it by the number of shares available to purchase in the mutual fund. Okay? Let's take a step back and talk about individual stocks and their prices. You know? When a company has a stock that's worth $1, and there's another company that has a stock that's $100, is the company with the $1 stock less valuable than the company with the $100 stock? Why?
Because of net asset value?
No. Right? The price of the stock is meaningless. Right? It's just a number. Right? There's no set percentage that you own when you own a share. You know, Facebook might say, all right, we're going to sell at $100 a share. But how much ownership does that share give you is the important number. Does that make sense? Okay? So, if I have a company, right, and my company's worth $1 million, and I'm like, you know what? I want to divide my company up into 10 shares of stock. How much is each share of the stock? How much is each share worth? $100,000, right? If I say, you know what? I'm going to change the plans. I'm going to create my company and I'm going to sell stock, but instead of creating 10 shares, I'm going to create 100,000 shares. What's my stock worth? $10. Is my company any more or less valuable? No, it's just we've just changed the price point. You know, we've given the ability, the opportunity for more people to buy it, right? Because you can't cut a share in half. A share is a share. So if my shares are $100,000 each, who am I catering towards? Institutional investors, you know, people with big money, right? I'm not catering towards, middle class, right? Generally, that doesn't happen. The company I'm going to be going to work for, they're focusing on institutions only, and the reason why is because institutions are generally a little bit more sticky than individuals, right? People like us are more fickle. Like when the stock drops, you might be more likely to sell it right away or buy it right away. That changes your market. When you have higher price shares, generally that means you're more likely to hold it. Generally, okay. I would be able to describe for a quiz, we'll have a mini quiz next week, what the NAV is. You should be able to explain, give me if I put the book definition of the NAV, you should be able to tell me what it is. If I said, what is the NAV? You should be able to describe that to me. And when I say you guys should be able to describe this to me, some things I'm gonna ask you, you guys are gonna have to look up on your own. It's not because I don't want to teach it, it's just because, we're talking about it, and I don't care if you give me the book definition, or in your own words, as long as it's right. Does that make sense? Okay, great. Mutual funds can be described as a basket of stocks, bonds, or other investment vehicles packaged in different ways. What are other investment vehicles? You can have a mutual fund that contains gold, timber, pork bellies, orange juice futures. You get into like weird stuff. But it's just a kind of conglomerate of a bunch of different stocks, or bonds, or a combination of the two, right? Bonds provide what? Income, right? In general, right? Because a bond, as long as the company doesn't go bankrupt, is going to provide a stream of income, right? Stocks, generally, they might pay dividends, right? They might not. But what do you hope when you buy a stock? That the value of the stock appreciates. Who invests in mutual funds and why? We pretty much already talked about this. Everybody invests in mutual funds, right? Approximately 75% of funds are owned by individuals. Bank, trust departments, pension plans, corporations, they all own mutual funds, right? Anybody can buy them, anybody can sell them, okay? Why are mutual funds purchased? Professional management, right? We don't have to concern ourselves with picking the stocks. We do research and say, you know what, this guy or this woman is a good investment manager, good portfolio manager. I'm going to let him or her pick those stocks for me, right? Diversification, right? You want to have a diversified portfolio so that in case, you don't want to have all your stocks in technology, because if technology falls off for some reason, I'm not talking about technology in the sense that we're not going to see more technology advances. I'm just talking about technology as an industry. The technology industry has been difficult for the last few years because technology is often innovative, right? And if you can't get a loan, right? If you can't get a financial backer for your innovative idea, it's a lot harder to innovate without the money, right? Yeah? Okay. Convenience and choice, right? You have a lot of choices when you invest in mutual funds. You can pick different managers based on their